Speaking to CNBC, the head of global macro strategy at ACG Analytics claimed the progress made in the Brexit negotiations has strengthened the pound, making European equities in the UK very competitive. Mr. McDonald said, "The UK has asked to work with the European Union, the pound has dramatically strengthened, and then European equities in the UK equities, are the cheapest equities in the developed world. They are a screaming buy relative to the United States, trading at 13 times earnings, the US is close to 18 times. However, the financial expert warned that if populism continued to rise in the UK once it is out of the European Union, the pound would weaken, making UK stocks, although still competitive, even cheaper to buy." CNBC Getty BREXIT News. Finance expert Larry McDonald reveals UK stocks are the place to be thanks to Brexit. He added, "So, I think over the next year what's going to happen is, with the populist rebellions as a possibility of coming into Parliament, the populism will rise, the pound will weaken, and UK stocks will be the place to be." Despite Mr. McDonald's warning, as government negotiators move toward clarity over the UK's future trading relationship with the EU, the so-called Brexit risks associated with the pound, includes to a potential rise in the Bank of England interest rates, have sent sterling rising 3.9% versus the dollar this quarter, its best performance since mid-2015. Against the euro, the pound has risen 1.4% since January, its best quarter since 2016. There are signs that optimism is beginning to return to the markets, with Viraj Patel, an FX strategist at ING in London, telling clients, "The recent move higher is evidence of the pound's cheapness and the inverse relationship with Brexit uncertainty. The pound has dramatically strengthened and UK equities are the cheapest equities in the world." Larry McDonald. In the absence of any sudden uptick in UK economic or political uncertainty, we expect sterling to continue on a path of recovery, with a 3 to 5% appreciation in the trade-weighted index. Valentin Marinov, head of G10 FX strategy at Crédit Agricole, claims when Brexit hysteria is down, the pound will get another boost as markets are more likely to respond to the available data. He said, "On the whole, Brexit concerns have taken something of a backseat since last week, and I think markets are focused on data." Mr. Marinov said he had a broadly positive outlook for the pound next quarter, particularly against perceived safe haven currencies such as the yen and Swiss franc, but he did not see it rising above $1.41. The news comes in sharp contrast to predictions from some of the world's top financial institutions made at the start of the year. Jekes, a macro strategist from Societe Generale, predicted that the pound would end the year at 1.30 against the dollar, and a pathetic 0.98 against the euro. He told Business Insider UK, "Lots of bad news is priced in and lots of bad news is likely. We expect 3 years of real GDP growth below 1% in 2018 to 2020, averaging 0.8% per annum, about a quarter of the world's average growth rate. We expect the Bank of England's MPC to keep rates on hold through 2018 and, ultimately, to be forced into further easing, against a backdrop of tighter policy elsewhere. Even with sterling making new lows in trade-weighted terms, we see only the pound sterling to US dollar meandering in a 1.30 to 1.35 range for most of 2018.